Hey folks, welcome to Market Intraday Analysis by InTheMoneyStocks.com, your leaders in pure technical analysis, avoiding all that Wall Street hype. Today, Tuesday, November 3rd, 2009. Well, folks, we're sitting on a flat day today ahead of the Federal Reserve FOMC meeting tomorrow where we'll get their rate decision. And again, it's not going to necessarily be a change in rate. It's more about their comments and how it affects the dollar. The dollar continues to be the key driver in every move in this market. That has not changed today. Every big spike up, every big spike down has been a result of the opposite move happening with the dollar. We'll go over that shortly. Now, the kicker today, again, the Dow down about 32 points, NASDAQ's down about 4, S&P 500 down about a point, really about as flat as you can be, coming off of a little bit of a gainer of type day yesterday. Now, we had some key trendline activity today I want to discuss on the technical side of the markets, and we'll go over a couple other things. I want to talk a little bit about the jobs number coming out over the next few days. We have the ADP jobs number tomorrow, then on Thursday, initial claims, and then on Friday, the unemployment rate. So the market, again, is going to be looking towards those numbers in a major way, including the Fed statement tomorrow at 2:15 p.m. Eastern Time. Be aware of that. Be ready for that. You will see volume increase. Volume today has really dropped off as everyone's just waiting for that ADP number and the Federal Reserve tomorrow. What do we know about that? Generally, it'll give a slight upside bias to the markets. You can see over the last hour or so how the market has made a move up. Now, again, the key levels are as follows here. What do you have? Well, you have this green trend line here. This green trend line, which basically worked as the highs from yesterday afternoon. See the high pivot right here yesterday into the close where we pulled off. That has worked very, very well today as a resistance point. And I want to just show you how. That trend line, again, scalps all the way back to this level here a couple days ago. And if you go back further, it's even farther back. But as you can see, you came up to that yesterday into the close. Today, we gapped lower and made a good push up. Where did we go? Right into that same line, green line right there. The key was also that you had this pink trend line sloping down, and this was the key level here. Again, I'll scan back to show you where it comes from. And right over here, if I scan down and kind of shoot out from the chart, you can see right here, there it is. You take the top pivot point right there, just underneath 107 from last week, and connect that all the way through here. And again, that goes from basically Thursday to the highs on Monday, and now to the highs here on Tuesday. And that was your short scalp. And again, we called that out in the chat room. Those of you that took that, very nice profits on that trade. That was really the best trade of the day, probably, as you can see, right from piercing that level, this level right here, green trend line, pink trend line, pierce, and drop. Look at that drop right back down. Then you shoot right back to it again, and the same play can be done again right off of that. Now, the first one's obviously the best one to do. The first hit of any trend line, especially a necktie of trend lines, is always going to be the maximum efficiency trade, meaning that it's the highest percentage chance of winning, and that again can be seen right there on the first hit. The second one is still a high percentage, but it's not nearly as high as the first one. You can see this second one works again beautifully, pushes it down. Now again, what happens when we get to the third, fourth, fifth time you hit that level? Every time you hit that, folks, you do see it get weaker and weaker, so it's more likely to break. By the third time here, you touch it and you just have one little bit of a fall, and then all of a sudden you shoot up and then break out to the upside. So again, do you see how you hit it once, twice, three times, and then on the fourth time you break through it? That's because it's the door theory. The door theory states that if you run into a door one time, you're not going to break through. Two times, not going to break through. Three times you may. Four times, very likely you will. And by five times, by then, you should be breaking through that door if you run into it full strength. And again, it's just that mentality of a trend line being a doorway that if you can push through that door, you'll fly out to the opposite side. Sure enough, right here, look at that explosive move right up. Where do we go? We close right above that green trend line, right at this high. See this high right here? This high, we close right up there, but then it does not confirm. Confirmation is another key factor we teach in the Research Center, and I do encourage you to come join that. Based on the key methodologies that we bring forth, you will be able to increase your knowledge, efficiency, and profits in the market quite a bit. I mean, it'll be unbelievable. We'll open your eyes to stuff we're able to show you. And again, it's all about teaching you. We're going to tell you where the market's going to, but it's all about guiding you and then teaching you how to fish instead of just giving you that fish. So again, up you go. Please note how you closed above the green trend line right here, but did the next candle confirm? What is confirmation? It's a close above the tail of the previous candle, which was the breakout candle. You do not confirm. That tells you you're going to come lower. That's exactly what you have done here. Now, the key is, again, look at this pattern. This pattern is another part of what we teach, which is price, pattern, and time. Time, again, middle of the day, early afternoon here, right around this 1:30 p.m. time frame. In addition, you had a nice move up, and now you've started to consolidate in a bullish manner. That is bullish consolidation right now, folks. And for that point, you want to look to see if this market has a little bit of an upside potential in it, possibly back to the highs of the day or to this blue trend line above, which would be a little bit of resistance. But again, there's your up move inside bars to the downside. That's creating a little bit of a bullish pattern, and that could be telling us there's a little bit more upside in this market to go today into the close. Again, that'll all coordinate with the dollar dropping. Now, what do I mean by the dollar dropping? Well, the dollar has continued to float lower today, and that's really been a key for this market. The dollar somehow gapped higher this morning, and what we've noticed again, and this is again just our methodology and our observations, we've noticed when the dollar gaps higher on certain days, especially coming off of days where the market's bounced back after a hard down day and the market is initially weak, what you'll see is the dollar gap higher and then fade the whole day. Well, what does that mean? When the dollar fades, it goes like this. It fades. Here's the gap up right up here, so it opens higher and then fades like this. What does that do? Well, on a weak day, that gives the market support because every time you tick down and go down, it's pushing the markets like this, or at least keeping them sideways to up instead of falling. And look at that. Basically today, that's exactly what you have. Here's your trend line, general trend line on the market today. Yes, it's been choppy all around, but you definitely have an upside little trend going in this market. And that's exactly, if I show you the UUP, which is the dollar index, look at that. So the philosophy, the methodology that we're using here is appropriately working. And I said this today at the chat room. Many of the chat room subscribers, the traders in the chat room said the same thing. What we said is, okay, guys, the market's gap, the dollar is gapping higher here. Be prepared, especially since the dollar gapped up into the 50 moving average, which, by the way, was isolated in the Research Center videos as a major resistance point where you'd look for a pullback. We said, when it hits that point, especially since you're gapping up today, watch for the dollar to fade. That will keep the markets from really collapsing today, and that's exactly to a pinpoint what has happened. All right, and again, you can see here's the UUP, which is the dollar index. The dollar gapped up, and look at the movement on the dollar. That's helped the spiders really from collapsing, and you've actually had that general trend up right here, where you can see you're just slowly floating sideways to up. The volume, look at the volume, almost minuscule at this point, almost non-existent for this point of the day, and from that point on, you have to give the markets a little bit of the benefit of the doubt unless the dollar were to start to get a bid. If the dollar gets a bid, it's all off the table. Vice versa, too. If the dollar starts to fall sharply, you will see this market get a bid as well. So again, dollar drops hard, markets will go up this afternoon. If the dollar starts to rally, then the market should pull back. That's really what it is. But generally, from the trend that I'm seeing in the dollar right now, you have to give this market a neutral to upside bias. That's what we called out in the Research Center last night for our premium subscribers to expect, basically a flat market off of a little bit of a bounce yesterday, ahead of the Fed meeting tomorrow, ahead of the ADP jobs number. All those factored in, that's what you're looking for, all right? So keep an eye on it, folks. These are your trend lines. You can see a master level on there as well. Please understand how to use this methodology. Join the chat room. Join the Research Center. You will gain so much out of it, folks. All right? Have a wonderful rest of the day. We'll talk to you soon. Take care.